So let us begin today. So earlier on, I mentioned we have a special guest from Ping An of China Asset Management Hong Kong. So please allow me to hand over the time to Miss Sophia Feng. Miss Sophia, please.
Hello, everyone. This is Sophia. Glad to meet you today. And let's get started from the market review first. Hong Kong and China market was one of the worst markets for the past 3 years. Especially, many investors had great hope for China reopen after COVID lockdown last year. But economic recovery didn't come through, and China started to face deflationary pressure. At the same time, the downturn in real estate sales and the credit demand continue under pressure. However, when we look at the year-to-date performance as of November 15, China market become one of the best performance markets, only behind US market. Hong Kong market index, Hang Seng index rebounded almost 60% from the bottom until October 7th, then dropped by roughly 15%. The rally was mainly driven by a series of stimulus policies released by policymakers since late September, results in sentiment recovery. Let's look at the fund flow. We have updated the data until November 15. As the left chart shows that the national team has been net buying CSI 300 ETFs since earlier this year. We can observe that the very strong buy points were in January, February, July, September, and October. If we compare the average daily trading volume of CSI 300 ETFs with last year, we can see a significant increase. For Hong Kong market southbound flow, the cumulative inflow exceeding Hong Kong dollar 600 billion in the first 10 months had already surpassed the total amount of last full year. Actually, the first 6 months cumulative southbound inflow has already surpassed the total amount of last full year. When we look into the current circumstances for economic fundamentals perspective, economic data shows mixed improvement. The chart date has been updated till the end of October. You can see that CPI improved a bit recently, but the PPI is still under deflationary pressure. After breaking above the break-even line, neutral line. However, breaking above the neutral line of 15 in March and April this year. After all, the PMI has fallen back below it and is currently stabilizing around the neutral line. However, in the lower right chart, we can see year-on-year change percentage of export data is very strong. Year-to-date, especially October data. So on one hand, the strong export activities have provided support to China's GDP. But on the other hand, we believe there are some front-loading effects due to the upcoming Trump administration 2.0, and as we know, the tariff 2.0 in 2025. That's probably lead new export orders starts to drop. On consumption front, retail sales improved a bit, but still weak. Travel data improved most, but spending still lag behind. Compared to year 2019, the latest growth percentage is only high single digit. On property side, new home sales were still contracting at the alarm pace until the late September when the stimulus policies have released. but we could still see the volatile in 30 cities sales data rather than a continued rally. So to what extent that the policy could stimulate the demand, or basically we just say to reduce the inventory, is still worth to watch. In terms of China's GDP growth, since last September, most of institutions has collectively raised their forecast data from a lower 4 to 5% to higher 4 to 5%. The consensus on the street now is China can almost meet the target of around 5%. For next year, most of institutions' forecast turned down to mid 4 to 5%. And this will be set at the Central Economic Working Conference in early December. Well, having said that, in general, for the macro environment, we still see a lot of uncertainties for China. Let's see the China outlook 2024. Well, I believe that at this time of point, it also for 2025. We are seeing the headwind from the real estate, which we just talked in property sales data trend. Also, since the current policies are more focused on debt swap and stock reduction rather than the demand level stimulus, we believe the real estate recovery still need more time. The way economic activity interact with each other is really connected. If the real estate sectors, which is a key part of the economy, doesn't rebound back as expected, it's going to be tough for consumer spending to improve a lot. Plus, there are not many direct policies out there right now to boost the domestic consumption. So overall, demand remains pretty weak. On top of this, companies are not seeing much improvement in their earnings, profits either. Usually, it takes a few quarters for a new policy to kick in and start affecting business earnings. If anything going wrong in that process, it could take even longer for things to get better. Lastly, we are dealing with deflation. China is still in a deflationary state, and with possible of U.S. tariff 2.0 coming in the next year, the deflation could actually get worse. Of course, we also have some tailwind there. Some of the which are supportive policies, policies are definitely important when investing in China. Let's say Central Huijin's market intervention, that is national team liquidity injection and new guideline of capital markets. Although people cannot expect the national team booming create a booming capital market by themselves. Over the past year, it is clear that the top leadership cares about the capital market and will protect the capital market, which has also improved the sentiment of many domestic and foreign investors. On top of this, the central banks is in monetary policy and government's fiscal policies, for example, RMB 10 trillion debt swap program, etc., which we have listed out for you on the next page. Well, when we were doing sharing in the last few months, we said we do think Beijing is anxious about the economy, but lesson learned from last year was that a lot of talking, but not much doing. Well, since late September this year, they finally released them. The first batch with the monetary policy and financial markets updates. We really boosted the two kind of policies really boosted the investor sentiment. It's worth mentioning that when non-banking financial institutional got the PBOC swap facility on October 10th, the high dividend yield stock sector saw a strong rise. This was mainly because these institutions were able to access funds at a very low 1.8% interest rates through the swap facility to invest relatively stable high dividend yield stocks, allowing them to essentially achieve a risk-free arbitrage. Plus, the RMB 300 billion relending facility for banks to support corporate share buybacks is also encouraging listed company to increase shareholder returning. The policies for property sectors are set by each province and the city individually. As we mentioned earlier, the policies aim to stabilize the real estate market and reduce inventories, but they don't really do much to stimulate actual demand. It is likely that there's still room for home price to drop in next year. Regarding the disappointing RMB 10 trillion local government implicit debt swap and the lack of consumption policies, we can only wait and see if any related measures come out next year to address the U.S. tariff 2.0. Let's update a little bit about the implication of U.S.-China relation in Trump 2.0 and his tariff 2.0. We borrowed some sell-side data which showed that applying the 2023 export data for calculation. In the bear case, the post we can see the highlight in red. Post-trade disputes average tariff rate raised to 60%, with no increase in China's export to rest of world. This is the last. Let me see. In the middle to lower increase row increase in China's export to ROW means the rest of the world. So in this case, it would be negative 2.4% of impact on China's next year GDP growth. In the base case, which most of institutions expect the post-trade dispute average tariff rate is more likely to raise to around only 35%. Here is 34.3% with no increase in China's export to rest of world. So the impact on China's next GDP growth is around negative 1.5%. In the bull case, the post-trade, I mean, the tariff rate is similar to the base case, 34.3%, with US dollar 216 billion increase in China's export to rest of the world. The impact would be only negative 0.5%. So when we see the table at the right hand, it shows historical relationship between effective tariff rate and US dollar China yuan exchange rate. We can see an obviously CNY depreciation when US tariff increased. However, given that the Chinese government is not likely to allow a significant capital outflow, so we expect a modest currency devaluation or depreciation might be allowed to partially offset tariff shocks. Other possible policies to tackle the U.S. tariff 2.0, such as counter-cyclical domestic monetary and fiscal policies to stimulate the domestic demand, acceleration in export diversification, just like the previous mentioned, the rest of the world, and the outbound FDI, etc., may also be implemented. Key economic targets, real GDP growth, deflation, employment, and the fiscal plan will be set at the December CWC. I mentioned previously the conference. Also, this target will not be officially made public until the two session in early March. I mean the detail of the targets. Yeah. So how to invest in the time of the uncertainty? We may refer to the Merrill Lynch clock, which has very clear demonstration on the asset allocation wise. So we could see that when the growth recovers at a lower rate and the inflation falls, that means the the lower left corner of this cyclical chart, that is the reflation stage of the asset allocation cyclical model. So at this stage, you can see that from asset allocation purpose, bonds is will outperform high dividend stocks or cash and outperform commodities. Yeah, this is the stage that we think China is currently at. I mean, in other stage recovery, overheads, deflation, we can we also list out the asset class that can outperform, but that was in different economic situation. So overall, we believe China's situation is at the lower left corner. So we can know the better perform assets. So that's all my presentations. I will pass to Darren. Thank you all.
Let's just take a quick break, okay? I have stuff to advertise. Okay, so now let's just take a short break to digest and absorb all the information that Ms. Feng has shared with us. So in this time, I would like to introduce everyone to our Poems Mobile Trade communities. For those who are new to Poems, okay, let's say you're not a Poems client, okay, this is our new and improved app, okay? So if you would like to be involved with other like-minded investors, okay, have a platform for information sharing, or perhaps stay updated with our staff postings and more, okay? Our staff post there quite regularly as well. Then I highly recommend that you download the Poems Mobile Tree app and join our communities today. You can just scan this QR code over here. So, and for those who are new, okay, let's say it's the first time you're seeing me, okay, your first time you're on your one of Poems webinar, no worries. You don't need a Poems account to view and post in our communities. You can actually create a community profile. It's free, okay. Although of course, I highly recommend having opening an account. It will allow you all the nice stuff that we can provide. Okay, so some of our more prolific communities, of course, are the US. I mean, this is just some samples, okay, of what we have. Okay, so US earning updates for US traders, growth stock picks, market updates, and even technical analysis you can see in the middle. Okay, it's all free, okay, and it's all real. These are by us, the dealers, or by our researchers, okay, and it's all in a very timely manner, okay. So the earnings come out latest, you get it within a few hours. You can see the earnings updates, a summary, a nice infographic just for you, okay. So if that sounds like your cup of tea, or maybe it's just something that you want to try out, maybe you just want to see what I'm talking about, then by all means, please, you can scan to download the Poems Mobile Tree app. If you're new, it should bring you to the App Store or Google Play if you don't have the app. And if you already have the app, you should really give it a shot. Explore the app. Okay, we have a lot of updates queued. We have a lot of new activities that you can take part on it. Okay, so if you scan this QR code and you already have the app, it will bring you directly to our communities tab. Okay, so I'm just gonna count to 10 and let everyone scan. Or if you're on mobile, I don't expect you to take another mobile phone and scan this. So just take a screenshot. Okay, just take a screenshot like right now. Okay, just take a screenshot. Later on, you can scan it inside your phone. Most phones are able to do that right now. Okay, now on the topic of communities, okay, let's say you're not quite sold on this, okay, so we actually have a Telegram community. A lot of us use this now, okay, and we don't just have one Telegram community. Of course, here if you scan this, it will bring you to our, as in my team's Telegram community, okay, and it will bring you basically to the global markets Telegram channel. We have Asia market updates, US market updates, ETF news from our issuers, and all the good stuff that they offer us, and all the events, including this and other educational webinars that are posted there as well. Okay, if you'd like to find out more of the communities, let's say you join this channel and you're like, not really my cup of tea. We have others. We have other Telegram channels as well. You can drop a comment on any of the posts. Either myself or one of my team members will see it and will point you in the right direction. Okay, same thing. Just grab a screenshot, or if you're on your computer, you can just take a quick, uh, scan of this one. It should direct you directly to Telegram. Okay, if not, it will direct you to the web page, and you can just take a gander over there. Okay, ready? All good? Okay, fantastic. So now let us dive. Oops, sorry, I pressed up. Okay, let's dive right into it. Okay, so today I have three simple agendas. Okay, firstly, I would like to talk about an ETF earlier on in the introduction. If you were here, okay, if you were here early, I actually talked about it. Okay, I just want to spotlight an ETF today. Okay, and I'll tell you about it in a short bit. And then for those who are not, okay, because not everyone said they had ETFs, okay, in their portfolio, I just want to do. It's only one slide. Okay, I just want to do a simple comparison of stocks against ETFs. Okay, finally, we'll have a quick Q&A session to end of today's webinar, and essentially end of the year for us in webinars. Okay, and wrap up the Hong Kong China markets for this year. Okay, let's move on. Let's talk about 3070.HK. Okay, Ping An of China CSI Hong Kong Dividend ETF. Okay, some basic information to start off with first. Okay, the underlying index is the CSI Hong Kong Dividend Index. You can see my little circles that I'm making. Okay, I'll just direct you where to see. Okay, it was listed, just some simple information, like listed in 10 February 2012, an impressive AUM of about 1.175 billion. We're talking billions, okay? Currently, the management fee of this ETF is a pretty modest 0.55 per annum. Where's my mouse? Yeah, okay, 0.55% per annum. Okay, and let's talk about the accumulative performance at the bottom. Okay, it's actually all in the positive. So we actually talked about this earlier. Like China had, Hong Kong, China markets had their up and downs. So it's pretty rare. It's a rare occurrence that you actually see this kind of performance total return. And it's not just like, oh, like the past 1 month, ooh, everything went up. It's actually a pretty consistent performance. Okay, so okay, let's move on to the chart. Okay, let's look on the chart here on the right. Okay, I know you can't see the tiny little words over there. Okay, but for essentially, I want you to pay attention to this white line over here. Okay, so this white line is actually what I'm talking about right now. Okay, and we are comparing against some other key indices such as the Hang Seng Index, CSI 300 Index, MSCI China Index, and the S&P 500 Index and High Dividend Index, all of which are lower. Okay, so this ETF has significantly outperformed other indices, and since the start of the Fed rate hikes, okay, it has maintained resilience and even growth. Okay, some will argue that this is actually growth. Okay, the Fed rate hikes had led to volatility across the global markets. Okay, however, this ETF has managed to withstand these pressures with a strong selection of good underlying assets. Okay, I'll show you the underlying assets later on as well. If you're invested in the Hong Kong markets, you immediately recognize them. Okay, so for investors seeking stability and growth, this historical performance is for your consideration. Okay. Okay, so now we look at the index. Okay, so let's look at the index. Okay, this one right here, you can see in this highlighted column. Okay, I want you to pay attention to these numbers first, and then I'll direct you across. You'll see it very easily. Okay, so Okay, so some considerations for you if you're looking for stability and growth. Okay, so this index consistently outperforms the other major indices in terms of total return. So let's look at this first part over here where the circle is moving. Okay, over various periods, okay, you can see these are annualized data, okay, year to date 31 compared to 24, 30, 15, 18, 21, easy, okay. And the 10-year performance, some people are like, oh, this only happened recently. Let's look at 10 years. 9, 1.88, negative 0.27, 5.2, 7.26, and 2.60. The stats speak for itself, okay. Okay, so we'll move on to standard deviation. Okay, so for standard deviation, it has pretty much a lower standard deviation. Okay, now we're talking lower is better. A lot of Singaporeans like O levels. Okay, lower is better. Okay, so-called better. I use that. Okay, it is indicative that your risk is managed more effectively, and this is offers you a more stable investment option compared to some of its counterparts. Like you see, oh my gosh, a deviation of 30. Okay, so 18. Okay, across board, 3-year, 5-year, 10-year, quite stable. Okay, and lastly, okay, higher risk. Sorry, not higher. Uh, Risk adjusted return. Sorry, I confused myself. Okay, so this suggests that for the risk that you are taking, you are also compensated well. Okay, this balances your risk and your reward. Okay, so enough about the index for a while. Okay, so let's take a look at this for a moment. Okay, you can see everything. If you just take a glance without reading, you see the first one, everything is down, everything is down, everything is down. Then, notice something starts to go up, something starts to go up, and it ends up pretty high. Okay, so we all know that Hong Kong markets have been a downtrend for a while this year, and have also faced significant volatility movements even recently. Okay, so how did this index fare during this period is what we are looking at during this with these charts over here. Okay, you can see that there are years over here: 2011, 2015, 2018, 2021, and so on. Okay, so if you may have noticed, in earlier years there was a big performance lapse. Okay, okay, all the markets were down, but we always try and see that silver lining. Okay, so minus 10%. Okay, the CSI Hong Kong Dividend Index. Okay, this one here. Okay, it fared better compared to some of the other indices. Okay, I'm not saying it performed well. Okay, but its downside was definitely cushioned and not so extreme as some of the others were. Okay, and observing the charts earlier on, I brought your attention 4%, 5%, 16%, 31%. Okay, these are all in recent years. Okay, and it actually started to pick up earlier. So you can see some are still in the negatives, or rather, all of them are in the negatives. And it starts to pick up a little bit, okay, a bit slow, but it's picking up and it picked up faster than the others. So we're talking relative performance here, okay, and it started to move in a positive direction. By the time the rest of them have moved into the positive zone, okay, it was already this one was already well into it. It was like 16% in already, as you can see from here. And then after that, for this one, our year to date is actually 31%. Okay, it's well into the positive range. Okay, okay, with a 31% positive value alongside the Hang Seng China Enterprises Index. Okay, so this is just to show you cushion downside, faster pickup. Okay, now more graphs. Okay, but this one is simple, it's obvious. Okay, you can see it across the board. Okay, from the period of 31st August 2010 to 31st October 2024, which was just about a month ago. Okay, you can observe, okay, that cumulative price return, okay, and the total return for the CSI Hong Kong Dividend Index is significantly higher. Just take a look at it at a glance. The bar is bigger. Okay, we look at the dark blue one first. This one isn't even here. This one is in the negatives. This one is 28%, 38%, and 8%. Okay, so just at a glance, significantly higher than the rest. Okay, and this substantial difference, of course, this serves to highlight the impact of reinvesting dividends on overall performance. And for investors, of course, if you're looking for an ETF, okay, choosing an ETF that focuses on high dividend paying stocks like this, it can be a strategic move to enhance your long-term returns through dividend reinvestment. Okay, and of course, additionally, some dividends can provide a buffer against price declines. I'm not saying dividend is king. There are some downsides to high dividend. Like if you see a stock like, oh, they pay me a ridiculous amount of dividends, okay, but the stock price keeps going down, you don't earn, you're actually losing. Okay, so we are talking about good growth stocks, okay, value stocks, okay, that also have a good amount of dividend, okay, that can provide a buffer against slight deviations and slight downsides as well. Okay, I know this might look a bit insignificant, but this is actually a correlation chart. Okay, so this chart depicts correlation between the CSI Hong Kong Dividend Index and the S&P 500 Total Return Index. Okay, right over here. Okay, for all of us who are, I think most of us are invested in the US market. Okay, the good growth, good liquidity, the whole package. Okay, the whole 9 yards. Okay, so we know what this is. This is the S&P 500 Total Return Index. So from January up until January 2006 up until about 31st October 2024, this is the whole length. But let's talk about 2009. Okay, over here up until 31st December of 2021. Okay, we can see that there's a mild positive correlation. Okay, the 0.22 over there. Okay, so this suggests to us that during this time, there was a modest relationship between movements in the Hong Kong high dividend stocks and that of the performance of US stocks. Okay, so it's, yeah, so basically the higher the correlation, the more closely they move together, up or down. Okay, so however, after January of 2022, which we are looking at over here, we can observe a significant shift and the average correlation drops to 0.1. Actually, just like a few months ago, it's actually 0.9. Okay, so this shows the significant decrease in the simultaneous movement between the two of them. So what does this mean for us actually? You know, if I talk about correlation, doesn't really mean anything. Okay, but what this serves to show is that we can use this ETF almost as a form of tactical asset allocation. Okay, so if you're seeking diversification is key, then of course investors can benefit from this reduced correlation. Picture this, okay? Let's say you want to diversify your portfolio, which is what is the general advice that people go with. Diversify your portfolio, you reap the benefits from across different sectors, different markets, different countries. Okay, but if it has very high correlation to each other, something that happens in one will influence largely on the rest of them. So sometimes, okay, I'm not saying that you should high correlation is bad, okay, but sometimes you want to use this tactically, you want to divert from it, okay, and this is where this can come in. Okay, so you can benefit from this reduced correlation, and this indicates that the ETF is also less influenced by the volatility in the US markets. And the US markets is volatile now. It's so many things happening, okay, as highlighted earlier as well. Okay, so this can act as a like a potential like a hedge, okay, against market fluctuations. Okay, also with the focus on high dividend yielding stocks in Hong Kong, it is also an option for investors who are aiming to enhance income generation and reduce your exposure to the US market dynamics. Okay, why now? Why now of all times? Okay, so let me discuss a pretty attractive entry point that has presented itself due to large discounts for H shares. Okay, so I had a question uh, the previous webinar. Okay, and I just want to put it out there. Okay, for those who may not be familiar of H shares and A shares. Okay, I want to draw your attention here. So it's the same company, but it's listed on Hong Kong. That is the H share. You look at the right side, you can see my circles. Okay, and it's listed in China, Shanghai or Shenzhen exchange. It will be the A share. Okay, so basically these are traded on two exchanges. It's the same company traded on two exchanges in two different currencies. Okay, so I just want to clear that out of the way. Okay, okay, so this entry point presented itself due to large discounts for H shares compared to A shares. Okay, so let's look at the chart on the left first before I talk about this. Okay, the light blue line, this line here that is higher, okay, represents the Hang Seng Stock Connect China AH Premium Index. Okay, while the darker blue line, okay, over here that is lower is the Hang Seng Index. So you can observe from this chart, it's starting to split a little bit. Okay, the gap has continued to widen since January 2021. And this widening indicates that H shares are trading at a significant discount compared to their A share counterparts. So we move to the right side now. Okay, we can see from this table, okay, the top 10 dual listed companies included in the dividend index. Okay, so you can see the discount. Okay, of course, Look at that. The H share discount is going at 37%, 23%, 24%. Okay, discount. Okay, it's all highlighted here on this table. Take a screenshot if you want. Okay, or grab a picture. Okay. So this highlights the discounts that are prevalent across the various prominent companies, and they are prominent companies. Bank of China, ICBC, China Construction Bank, China Mobile. As long as you invest in Hong Kong, China markets, you definitely heard of this in part of your research or part of your discovery. Okay, so historically, big discrepancies between H and A shares tend to correct themselves over time. Okay, which means if you invest in H shares now, you could give a good yield as the market corrects and adjusts. So now let's pay attention. Now we go back to the left. Okay, a lot of left and right today. Okay, look at this point here. This gap here in the middle. You notice that they're starting to come together a little bit. Okay, so there seems to be some momentum towards a correction that is starting to take place as well. When I shared this previously, this line had not appeared yet. This line up and down towards each other actually had not appeared yet. So now we can see some momentum towards a correction. So this is the attractive entry point that we are talking about. Okay. So fund flows. Okay, we all know that some time ago we're talking about the fund flow out of China, then back into China. Okay, so I just want to briefly explore from a fund flow perspective. Okay, so in summary, you see the chart on the left. Okay, over here. Okay, this chart here, as represented by this dark blue line. Okay, we can see the percentage of shares being held by southbound investors is growing. Okay, most notably, there's a steady increase in shares held, okay, which might indicate growing investor interest and confidence. Okay, and on the right, okay, you can see here, these are the southbound shareholdings of the ETF's constituents. And you can see uptrend, 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 uptrend. Oh, sorry, my circle's not coming all the way. Uptrend, uptrend. Okay, is moving in a consistent upwards trend. Okay, we are spike in the recent months is almost at 19%. So this growth, okay, can also reflect increasing demand and positive sentiment towards this ETF's constituents. Okay, additionally, just a few months ago, onshore or southbound trading for this ETF had actually started after the launch of the expansion of eligible ETFs, okay, under the Hong Kong Stock Connect. So we can expect southbound inflow moving forward as well. Okay, now, from a valuation point, I got justify why, correct? So, from a oops, sorry, I pressed up instead of down. Okay, from a valuation perspective, okay, let's take a look at this. Okay, uh, okay, China Big 11, okay, presents an attractive entry point for investors. So the 11 are over here. Okay, these are the stocks that I'm referencing. Okay, as compared to the US one. Okay, so those of you who invest in US stocks, don't tell me you don't know what Bank of America, Citigroup, Wells Fargo, Verizon, AT&T, T-Mobile. You know what all these are. Okay, we're comparing them horizontally. Okay, so ICBC, ABC Agricultural Bank, China Construction Bank, Bank of China, okay, China Mobile, China Telecom, Unicom, PetroChina, Sinopec, and Sinop. Okay, so these are the 11s that I'm talking about. I'll come back to this later. You can take a look. Okay, so let's take a look at this chart over here. Okay, okay, good growth and good economic integration over the years. Okay, and in terms of total assets, that's this one over here. Okay, all over here. Okay, you can see from the left. Okay, this and my mouse, China Big 11 outpaced the US counterpart. Okay, reaching up to almost 30 trillion as of this year. Okay, now we move on to the middle. Okay, from this middle graph over here, you can see that their earnings growth is resilient. Okay, it's got a little bit of a down. Okay, but it bounced back. Although there was this fluctuation along the way, there's a strong rebound in 2024. It reaches to over 250 billion. And lastly, on the right over here, we can observe that their market cap. Okay, just talking about market cap. Okay, relatively stable. There's a bit of a surge. Okay, this could signal potential for future gains. I can't just show you all the nice parts. Okay, they do lose out a little bit in market cap, but we're focused on this bounce over here in terms of the recovery. Okay, so the China Big 11. Okay, they also play an important role. Now we're looking at the bottom. Okay, a large role in their nation's economy. Okay, if we take a look at their assets to GDP ratio below, okay, they have grown from 108% over here, and we're moving all the way over here, okay, to 152% in 2024 year to date. okay, as compared to 52% for their US counterparts. Okay, this shows their contribution to domestic growth. Sorry, I'll do a quick time check. Okay, I'm just going to go quickly from now on. So in a nutshell for this slide, we can observe a few points, okay, which is earnings resilience, okay, good valuations showing potential growth, okay, and they're essential to the Chinese economy and critical component in the future economic stance of China. Okay, so here is it once again. I'm just going to count to five. You want to take a quick screenshot of what I was referring to? Please go ahead. Okay. Okay, let's quickly wrap up this section with the top holdings. Okay, so you can see on the left the portfolio allocation. Okay, over here, okay, financials leading with about 47%, energy with about 26%, communication services with about 12%. Okay, the rest kind of mix of utilities, industrials, materials, real estate. Okay, although more exposed to the financial sector, you can see, oh, so many financial. Okay, okay, you can, yes, it is a little bit, okay, but there are some very prolific companies here that will grant you good growth exposure, including China Mobile. Where's my China Mobile? It's over here. Okay, Sino. Okay, I like talking about Sino. Okay, very good growth. Okay, value stock as well. And China Shenhua. Okay, a good coal business. Okay, worth checking out. Okay, individually as well. Okay, now we did a value stock series some time ago. You can go and check that out on our Philip Capital YouTube channel. Okay, I just want to end this off over here. Okay, so we can move to the Q&A session. Okay, quickly. Okay, stocks versus ETFs. I assume a lot of people are well versed in stocks versus ETFs, but just going to briefly breeze through it. Okay, of course, stocks, successful company, significant gains. Okay, in investing in long term, of course, you have greater control over your portfolio. Okay, but unfortunately you bear higher risk, and if the company performs poorly, of course, it can damage your portfolio, and less diversification, and you're exposed to company specific risks. Okay, but for ETFs, instant diversification, single purchase, you buy one, you get many. Okay, spread your investment across multiple companies, reduce your risk. Okay, because they're diversified, is considered less risky than individual stocks, but while offering lower risk, typically they have a little bit of a lower potential return. Okay, so you decide what's best for you depending on your investment goals and risk tolerance. Okay, now let's move on to the Q&A session. I'll be reading up some of the questions. Okay, if you do have questions for Ms. Feng, please do input it in the Q&A section. I will do my best to get to it. I was a little bit long-winded, so we're a little bit behind time. Okay, so you find the button at the bottom of your screen. Okay, so now I just want to take some of the questions. Okay, maybe I'll go to the Q&A session. Okay, maybe I'll just take this first one. Which news media to get China news, China Hong Kong news? Okay, for Mr. Kenny Yap. Okay, personally, of course, I will only try and recommend getting stuff from Poems. Okay, but I understand sometimes you maybe just want some news outlets. Please do try aastocks.com. Go and Google it. Okay, so next question for Miss Sophia. Which sectors in the Hong Kong and China markets have performed exceptionally well this year? And do you expect these trends to continue into 2025?
Okay, let me take this question. Um, from the beginning of the year to the mid-November, since we primarily focus on Hong Kong market. If we take a look at the Hang Seng Index and the Hang Seng CEI, the China Enterprise Index, to represent Hong Kong stocks and Chinese companies respectively, the best performing sectors according to gig sector classification, information technology, financials, consumer discretionary, I believe. The technology sector has rebounded significantly, driven by a strong demand for digital service and advancements in AI. Chinese tech giants have also seen a recovery due to government support and increased domestic consumption. Compared to last year or a couple of years before. For 2025, the trend is likely to continue, I can see. This is driven by ongoing innovation and the government policy promoting digital transformation. Yeah. Performance contribution of financial are mainly from China's state-owned banks, as um, Darren has just mentioned in the introduction of ETF. The Chinese economy has shown signs of stabilization and recovery, boosting confidence in the banking sector. That is the first reason. And the second reason is continued government support, including monetary easing and regulatory measuring, as I mentioned before. This all provided a favorable environment for banks to operate and keep a growth rate. And another reason may be many state-owned banks have successfully managed their non-performing loans at this year, leading to improved assets quality and to some extent reduced the credit risk. Given the valuation of the state-owned banks is still very low, less than 0.5 times, and the dividend yield is around 7%. So they still hold investment potentials next year, I believe. And the consumer discretionary sectors have seen a robust growth, driven by a strong consumers. Relatively strong consumer spending and recovery post pandemic in retail sales. Yeah. In this year, China's consumption recovery was significantly increased, especially in travel and spending during the major holidays, surpassing pre-pandemic levels, as one of my charts showed previously. Yeah, and I think the in terms of next year, like many of them in the many investors in the market, we also think the next year's consumer spending will spend depends on whether the policymaker publishes stronger stimulus policies for the consumption side. This could involve shifting some of the support from the supply side to the demand side, whether it's a boost domestic demand in response to Trump's tariff increase or stabilize the economy. So in this scenario, the consumer sector is likely to see a significant rebound. Yeah, that's my answer.
Thank you. So let's take another two questions to wrap up. I apologize to the rest. There are quite a few questions, but maybe we'll just take from two more questions because we're reaching 8 p.m. Okay, so from an anonymous attendee, okay, which sectors are likely to drive growth in the Hong Kong and China markets next year?
Well, um, I think if we look at the current situation, considering our previous analysis, along with the current economic conditions, the monetary and fiscal policies that have been implemented, and some challenges we still face, China is still in the, third quarter of Maryland clock, which is the lower left corner. Yeah. So this means we are dealing with low inflation, even deflation pressure, and even facing some, also the economic growth rate need to pick up. We're at this stage. So at the same time, with the U.S. election wrapping up, if Trump really increased the tariff in a large to a large extent, we believe that China will strengthen its fiscal policy to mitigate this effect. So during these uncertain times, we see high dividend yield stock with strong certainty as a good short-term position, as well as valuable for mid to long-term investment. From a policy perspective, China is encouraging listed companies to enhance their dividend payout ratio, in addition to nine measures aimed to encourage companies to increase their dividend payout ratios. The central bank has also created special re-lending facility, as I previously mentioned. Yes, this is based our the case standing at current point. In terms of sectors, the state-owned banks, state-owned energy companies, oil companies and coal companies, along with some material sectors, companies that benefit from the strong demand in renewable energy resource. Energy source material company will be benefit from the current situation. Yeah, I think that's my question. That's my answer. And in a nutshell, we prefer value stocks at this stage more than the growth stock. Yeah.
Thank you, Ms. Feng. Okay, so let's just do one last question. I've been taking from people who asked very early. Maybe I'll give someone opportunity to ask towards the back. Okay, so are there any anticipated reforms or new policies in 2025 that could significantly affect the Hong Kong or China stock markets?
Well, yes, for sure. It's possible that more anticipated reforms and new policies in next year, I believe. Also, we don't have a clearly idea or the specific approach or measures they will release, or to what extent they will release at this point. But I think there's still some directions worth to looking forward to. So in terms of economic stimulus measures, the Chinese government is likely to introduce further economic stimulus measures to support growth, particularly in light of any ongoing internal and external economic challenges. This would include fiscal policies aimed at boosting domestic consumption, and like I previously mentioned, and the infrastructure investment, which would I think positively affect market sentiment. There also be possible that the potential to implement easing monetary policy, of course, as such interest rate adjustments or liquidity measures from the PBOC. This all would influence the market dynamic, I think. Well, anticipated reform in the I think real estate sectors include measures to further stabilizing the house market and manage local government debt. That would also have many impacts to investors' sentiment. I believe the scale of the measures would increase if the property sales become even deteriorate next year, to prevent any systematic risk happen. Yeah.
Okay, that's great. Thank you so much, Miss Sophia, for joining us tonight. Okay, and thank you everyone for staying to the end. I hope we have actually answered some good questions for you. Okay, that has been it. It's been a great year for us. Okay, and I wish everyone a more fruitful year ahead.